When a six-figure income still leaves you feeling broke at the end of the month, the issue is structural. Your financial life is buckling under the weight of disorganized, manual spending. Today, we are going to fix that by building a system modeled on how the top 1% manage their wealth. The common denominator among the ultra-wealthy is ownership of businesses, assets, or trusts. This machine automates that ownership, so you stop being owned by your bills. The framework is called the 25-15-50-10 system. We are going to take your next paycheck and strictly divide it into 4 operational buckets: 25% for growth, 15% for stability, 50% for essentials, and 10% for rewards. To set this up right now, you need 3 things in front of you: a recent pay stub, a list of your essential bills, and your banking app open. Establishing this precise architecture shifts the burden of building wealth away from your willpower. Once these transfers are active, your financial growth happens entirely in the background. Step 1 is your growth engine, which receives exactly 25% of your income. To start, you need a tax-advantaged investment account. In the US, that is a Roth IRA. In the UK, it's a stocks and shares ISA. These accounts are designed to shield your growth from the government. Peter Thiel used this exact infrastructure to turn a small investment into billions of dollars without paying a cent in capital gains tax. Go into your banking app and configure an automated recurring transfer for 25% of your take-home pay. Schedule this to land in your investment account the same day you get paid. Within that account, you will use a 3-fund portfolio. This is the most effective strategy for beginners, allowing you to own a slice of the entire global market instead of gambling on individual companies. Dedicate 60% of these funds to a broad U.S. stock index fund. Allocate the next 30% to an international stock index. The final 10% goes into a bond fund, smoothing out stock market fluctuations. Avoid the temptation to put this 25% into individual high-profile technology stocks. Unless you are a professional analyst, picking single winners is a form of guessing that creates unnecessary risk. Ensure you select accumulation-type funds. This guarantees every dividend your investments earn is automatically reinvested to buy more shares, accelerating your compound growth. Automating this diversified portfolio removes the need for emotional trading. You no longer have to check charts or time the market to guarantee your assets grow over the coming decades. Next up, we build your stability shield. Open a separate high-yield savings account returning 4 to 5% interest and set an automatic 15% paycheck sweep to go directly into it. To find your target balance, calculate your monthly baseline. Add together only your survival expenses: rent, basic groceries, transport, and the internet. Take that total and multiply it by 5. This money follows 3 absolute rules. It stays out of the stock market, it carries 0 risk, and you must be able to access it within 24 hours. Having a liquid stability shield is the structural mechanism that protects you. When a life emergency happens, this fund takes the hit, so you never have to sell your growth assets at a loss. Now, audit your remaining expenses. Your rent, groceries, transport, and utilities must be capped at 50% of your take-home pay. If your costs exceed this ratio, you must optimize housing and transportation, the 2 largest drains on most budgets. Moving closer to work or renegotiating your rent are the fastest ways to hit this mathematical goal. Regarding transport, purchase used reliable vehicles rather than leasing new models. A car is a depreciating liability. Paying a premium for social status is one of the most common ways to stay broke. To keep this 50% cap in place, use the 7-day rule as your primary systemic defense against impulse spending. Force a 7-day waiting period on any desired luxury item. If the excitement has faded after a week, skip it. Only execute the purchase if the item provides undeniable, lasting utility to your daily life. Capping essentials at 50% prevents lifestyle creep. It ensures that as your career income scales up, the surplus is automatically funneled into wealth instead of being wasted on higher bills. Your final 10% goes into a secondary checking account specifically for guilt-free spending. Automate this transfer to happen every payday. This capital is reserved for vacations, hobbies, social experiences, and gifts. Because this money is already spent in your system, you can enjoy it without feeling like you are sabotaging your future. The boundary is uncompromising. If this account balance hits 0, you cannot siphon money from the growth or stability buckets to cover more fun. You wait until the next paycheck. Engineering mandatory joy into your finances eliminates the feeling of deprivation. This sustainability is the reason this system works long-term, while most strict budgets eventually fail. Your financial reality has changed. Upon your next paycheck, your wealth will automatically distribute into assets, a safety net, your living expenses, and your weekend funds, without you lifting a finger. The final rule of the system is simple. Never manually override or interrupt these transfers. Let the banking automation maintain the discipline for you. With your current money handled, you can stop spending your mental energy on budgeting. Your focus should now shift entirely toward acquiring the high-income skills needed to increase your total cash flow. Establishing this machine buys you the mental bandwidth required to focus purely on exponentially increasing your future income.